very important to write realistic numbers which can be executed rather than taking some pro forma or co-star report and then just throwing it over the wall and expecting somebody to execute it. So in any business, acquisition is great, but if you can't execute on your business plan, your business is going to fail. And it's that simple.
Hi, good afternoon, folks. My name is Akash Jain. I'm your host for today, and I'm very, very excited today to welcome Sandhya to our show today. Sandhya, welcome.
Thank you so much for having me, Akash. And it's such a great thing to put together a podcast and help your listeners. So kudos to you for doing that.
No, thanks a lot. I am very excited, guys, because Sandhya is the queen of asset management. I have seen her work. I have visited with her several times over the past few years. Sandhya, to start us off, tell our listeners, how did you get into this multifamily or investments, if you may? And what's your background? What's your story?
So moved to Dallas, Texas about 30 something years ago with two suitcases in hand, like most of us immigrants do. Came to go to college here with a full scholarship because otherwise I couldn't have afforded it. Parents made barely $60 a month back in India, which was plenty for us there, but it's nothing when you move here and college costs at least $10,000 a year kind of tuition. Went to college for engineering, got an electrical engineering master's, and then immediately started a W-2 in a technical field and then realized very quickly in that W-2 that the sales and marketing people made all the decisions, business decisions, and I really wanted to understand how they did that because us, the technical folks, simply kept executing whatever they asked us to do. So the company was kind enough to pay for an MBA, which is where I got my business knowledge and started trading stocks very actively, joined investor clubs, etc., and started seeing the power of investing and how that can really, in a decade or so, replace your W-2 income. So I was making good money with stocks, had kids, then realized, okay, just with trading stocks, I was making more money than my W-2 salary, base salary, not quite the options and everything, but definitely the base salary. So then it kind of made, work optional style. And my husband had a W-2. I was doing well in stocks. So we needed a place to kind of save on taxes. We had no other way to save on taxes. I looked at starting a business, etc. I didn't have some fantastic idea. So I turned to real estate. I was in Dallas and single family rentals weren't doing much. And it was a lot of work that required the skills of a handy person, fixing a leaky toilet on Thanksgiving wasn't quite my thing. So I went into multifamily right away. So I went from 0 doors to like 86 doors as my first deal as a general partner after attending a weekend event that taught me how to do a syndication. And so that's what I have done ever since. That was back in 2018. So it's been about 7 years now since I got into this business. But, I've been diversifying quite a bit and I've continued to keep stocks for liquidity, etc. So that's how I got into multifamily.
Very cool story, Sandhya. I think a lot of us immigrants have a very similar story.
Mhm.
Again, very similar background I have is, hey, an engineer with an MBA, did some consulting, was in corporate, and so on and so forth. But hey, I can resonate very, very well. But obviously, you've done very well in your multifamily. What keeps you ticking? What is your why? Why do you do what you do?
Well, there's two reasons. The one is, of course, to provide something and to show my kids that as mom, I'm still a working mom, but I'm able to balance it by dictating my own schedule. That's the fun part of entrepreneurship. But the more fulfilling side is when I came here with two suitcases as a student, I lived in a C-class apartment. And so I saw how the finer side of, the expensive homes were. I went to a place called Highland Park. That's where my college was, SMU. So I saw how the suburbia people lived in a really fancy lifestyle. And I said, let's bring some of that community neighborhood feel to apartments. That's why community activity is a big thing I do. The PTA mom at heart and this, community building is what I've been doing. So back in COVID and stuff, we still managed to do community activities, maintaining that social distance. So the fulfilling side as well as the selfish side both came well together in multifamily, at least until these interest rates started going up. And then we had a problem.
That's an amazing why, hey, giving back to the community as well, right? Hey, obviously it's helping you live a life and, be prosperous and getting generational wealth for your family. But at the same time, building those communities is
Hmm.
extremely important. Being able to take care and provide shelter to hard-working people, it's an
Yes.
amazing why. And kudos to you for giving back to the community. Now, before we get into some of these boring conversations, what do you do on the fun side? I see that you have a couple of really good paintings, Van Gogh, right behind you. Do you have artistic band, or what is something fun that you do in your daily life?
So we love to travel, and my daughter and my husband are really into art. I'm a little bit less, but there are some favorites I have. There are some favorite artists, and therefore I'll go to some museums. But travel is my favorite hobby, and especially hacking travel, finding those bargains, being able to hack my points, etc. So I can, let's say, fly business class for a fraction of the cost would be a fun thing to do. But just being able to see more places in the world because it gives you such a different perspective. And every time I come back here, to Dallas, to the United States, I realize how blessed I am to be able to live here. And so until you visit, countries like we have some exposure to places like India where 24/7, even electricity and hot water is not guaranteed. But until I take especially my kids to, see those things, you don't realize just how lucky you are to be living here. And I want that exposure. But travel is so fun.
Very cool. Hey, thanks for sharing a lot of that. Another question, Sandhya, getting back to the subject here. Obviously, I've seen you at a number of apartment complexes, so I
Mhm.
believe that's a focus area of yours. Is
Mhm.
there a particular niche that you have in the apartment when you invest in apartments, or are there any other asset classes that you generally like?
All the way up until 2022, when interest rates started going up, I was all into multifamily in Dallas, the market that I know like the back of my hand, having lived here more than 30 years. And I focus on value add, meaning there's something you can do to turn that property, make it a better property in a better community, but also therefore add more to the income. So it was not just a purely yield play, where you keep collecting the same rent and the same sources of income. So instead, we try to creatively find other things residents spend money on, such as washer dryers or internet, etc., and bring those dollars to us instead of some other service provider. And so we find the ways by which we can find what renters want to pay for and which adds to our income. So that's the value add concept. But once the interest rate started going up significantly, like I did two deals in 2022, we did both of them on a fixed rate because we realized rising interest rates was going to be a big risk. So after that, I started diversifying. I still needed a play for my taxes, but I didn't see multifamily doing much. There wasn't much activity in 2023. I pivoted to oil and gas. So I've been investing in oil and gas since then, which provides great depreciation benefits. And crude oil prices have been doing pretty great these last couple of years. So I gotten most of my investment money back. The other thing I like to do is a technology fund. We have our roots in technology, so we understand the potential of various technologies. And so I've done two rounds of a technology fund as well. And the basic thing is, do you understand how this technology is positioned in the marketplace, the threat of competition? Have the founders done something before which is similar and had successful exits? Or is it, two guys in a garage trying to make it on Shark Tank, right? You need to be able to distinguish that and see how it differentiates from the products here. And so far that's been successful. But again, it depends on the risk level that you're able to tolerate, how long you're willing to wait for your cash flow. Do you need cash flow immediately, etc.? So all of that factors into the type of investment you are comfortable doing.
Very cool. Technology, travel, real estate, oil and gas. Wow. Help me understand, hey, as we are already into the fifth month of the year
Mhm.
for 2025, how do you see this year progressing for you? Hey, are there any deals you've already done this year? Or what is the plan for the remainder of the 6, 7 months that we have left in this year? How do you see this year
So,
playing out?
so I currently have five multifamily assets still active, which is a lot of hands-on asset management work, and I'm the primary asset manager on my deals. So I'm the boots on the ground, I'm local. So that takes up a lot of time. It doesn't pay a lot. A lot of the payment and money making is usually in the acquisition phase or the disposition phase, provided your cap rates cooperate. But this asset management phase is what's crucial because if you don't do it right, you could lose a lot of money. And unfortunately, this is also involving other people's money. So that takes up a ton of time. So asset management is still my main focus. I run a mastermind on it. But I've done one oil and gas deal this year, and we'll probably have one more before the end of this year. And that's the avenue that I'm sharing with investors if they need a tax break. But they need to understand the risk because crude oil price is something that fluctuates tremendously. They can get nervous as it fluctuates a lot. It even went down to almost zero during COVID, etc. So that's the second thing I'm doing. I am a little concerned about the effect of pricing. I don't think anything has gone down in price in the last few years. Expenses are going up. I have still underwritten a lot of multifamily deals, but none of them pencil to the level of cash flow my investors want. So a lot of people are pivoting to the fund model, which is, a debt fund or some kind of a fund that gives you a constant fixed rate return and then maybe an upside later. And that's the kind of place that we're leaning to, as long as the asset backing it is okay. Because if you try to rescue a distressed asset in a second lien position after the primary lender, I mean, the deal is obviously not doing well. So what is the hope for that? So you got to be careful. But if you carefully choose like fix and flip types of debt funds where you are in a first lien position on those properties, those could be good avenues. And that's what I have loaned to on a couple of deals.
Got it. I've been hearing a lot about debt funds lately, and it's the underlying asset which is absolutely paramount and how the funds are lending their money. Great to hear your thoughts on the oil and gas also. So the fund that you have running, is that an exploratory fund or is it already producing fund?
So we only invest on mineral rights for wells that have already been drilled and show oil. The unknown is still how much oil it's going to produce. So that's why I don't want to invest in just one well. So I want to invest in 5 or 6 wells at least so that, you have an average production that meets whatever you underwrite for. And you need to always stress test it, just like we do with multifamily. There's a certain occupancy and certain amount of collections I need to break even. So similarly, you have to do your break-even analysis. The typical returns seem to be in the range, like since 2023, what I've done so far. And again, the future may be different based on the oil prices, but it's about 2.5 to 3x in a 7 to 8 year period. That might take longer if crude oil prices fall more. But the biggest reason we go for it is because that year one, we're getting that 80% depreciation with no recapture. See, in multifamily, every time a deal exits, I have to worry about that recapture taxes and then find another deal or a 1031, etc. You don't have that. That's what makes this attractive. But again, we only drill with large operators. So it's not like I find a mom and pop who are spending money on drilling and then run out of money 6 months later. So these are huge, major corporations. And so we are not the operators. They are the operators. And we invest in mineral rights and we buy that access for several wells which have already started producing. So we're not in stage 0, but we're more like in that initial phase that they've started drilling and shown the oil.
Very cool. Are you doing all of this your syndications or are you doing a fund of fund model?
Syndication. So me with a couple of others, we just combine and do it. We haven't done the separate fund because there's the expenses associated with it and the hassle of K1s later. But we have a pretty good relationship, and I think a lot of GPs are afraid that their investor list might get stolen by somebody else. But, we're all grown-ups. We all have those agreements. We know what it's like. We have that trust established. So far, I haven't had that problem. But, it's whatever is your comfort level. I certainly don't want to be doing K1s in the future if I can help it.
Excellent. That's some great advice there, Sandhya. But before, again, I think I continue, I want to throw in a question which maybe let our audience know about a little bit about yourself. A good movie that you may watch anytime.
Top Gun has always been my favorite. It's what I watched as a teenager back sitting in India and said, what a cool country this is. I want to come here. And it's because of the character. So Tom Cruise isn't perfect, but he does his very, very best to fulfill the mission. And I can't wait for his Mission Impossible to come out very soon. Ferris Bueller's Day Off is another phenomenal movie because I watched it as a school kid. And so Ferris was my high school hero because when you have a perfect day in Chicago, you need to spend it having fun. So don't forget to have fun because stress is something you can't control and it's always going to happen in your life. But don't forget to have fun, and which is why vacations are a very big part of my asset management. So I still visit my properties all the time, but going out on trips is very important. I'm wired, I still log in. You have excellent Wi-Fi anywhere, so you should be able to mix a little fun in your everyday life. Otherwise, if you aren't having fun, what's the point?
Tom Cruise, it is, huh? That's one of my favorites as well.
Yeah,
Uh,
phenomenal movie. Like whenever possible, I name my things Top Gun.
did you like the second one as well, The Mavericks?
Yes, Maverick was good. I think it was done well. I was surprised it was as good as it was, but yes, I liked Maverick.
Very cool. Very, very cool. Another question I wanted to ask you was around asset management itself, right? I think there is a reason why all of us in the multifamily world call you the queen of asset management. Tell our audiences, why is asset management that critical? Hey, I live and buy the fundamentals, which is buy right, finance right, and manage right. That asset management is that manage right part of it. Why is it critical to get that third part right as well?
So a lot of people separate the acquisition phase from the asset management phase. But if you ever have to actually manage an asset, you know how critical that input is in the underwriting phase. So we actually talk about due diligence and upfront underwriting by talking to your asset manager or a property manager who is giving you that budget. So it's very important to write realistic numbers which can be executed rather than taking some pro forma or co-star report and then just throwing it over the wall and expecting somebody to execute it. So in any business, acquisition is great, but if you can't execute the business plan, right, that's why you have chief executive officer. You don't have chief acquisitions officer. So asset management and execution is where money is made. So if you can't execute on your business plan, your business is going to fail. And it's that simple. So you have all these investors, maybe you had the best marketing slides and they all wired money to you. If you can't execute that plan and give them distributions and therefore meet or exceed what you projected to them at the beginning, they're not coming back. And when you actually fail and you lose people's money, like it's been happening the last couple of years, those investors are not going back to that sponsor and they mention their names. So, your reputation kind of gets ruined. So this is the heart of every company is the execution. That's why you have chief executive officers.
As a CEO, you're running your apartments and
Hmm.
making sure that your apartments are executing the business plan that you laid out for your investors, and you're able to
Correct.
return the 2x and the 3x's of the money that you promised that
Right?
you're going to return.
Yeah. Because if you don't do it, what happens? You
Your next,
fail, you're
yeah,
not making money, and it's going to be much harder for you the next time around.
absolutely. Thank you for that. How do you value your property? Are you still looking at the underwriting numbers, or are you obviously you're looking at the market? But how are you pegging that cap rate? How do you make sure that that cap rate is better than the cap rate that you purchase it at?
So the disposition strategy is completely dependent on market conditions at that time. Usually, when we underwrite it, we actually underwrite it for a worse market condition or higher cap rate at exit than at entry. But your cap rate is determined by the market. What is the market willing to pay for your property based on so many different factors. But the first one is what is the interest rate? And therefore, what is the purchasing power for your buyer? So think of it just like a single family. If you want to sell your single family today versus 3 years ago when interest rates were super low, you could see the big difference in price, right? So if you're a buyer, you're trying to buy something. If interest rates are lower, you can buy a more expensive property. So it's the same concept. That's very important. But how do you base it? Well, you look at comps or competitive properties that have sold in the area and in that similar vintage type in your local market, just like with comps of a realtor does for single family. In this particular neighborhood, like Highland Park in Dallas, for example, is a very fancy neighborhood where your price per square foot is a lot more than, say, certain parts of South Dallas. So similarly with multifamily, you have tons of market data. A lot of it is coming from places like CoStar, but also the major brokers, because we buy these, 20, $30 million apartment complexes from the major brokers like Marcus and Millichap, CBRE. The really big names in the industry are the ones who can evaluate the property. And now that we've especially started seeing so many more deals in the market, yes, your NOI, net operating income, is very important because net operating income annualized divided by the cap rate equals your property value. But there are many other factors because if you're trying to promote this as a value add, what is your net rental income today? Net rental income is the most important parameter because that's the meat of the money you make. A lot of people focus on other income, but that net rental income, what is it today? How much is it going to grow? And by doing what? So let's say you want to sell your property a year from today. You want to get some guidance from the listing broker as well as a lender broker's viewpoint as to what they can lend to, what they can sell to, and position, let's say, 2 to 3 units in every floor plan to make that rent bump and show a proof of concept, because that's the value add for your buyer. That's how you plan your disposition strategy. And a lot of it does, unfortunately, depend on interest rates and cap rates at that point, as well as the potential. Where is the potential? So start viewing your property from the lens of a buyer if you need to dispose it in the next 6 months to a year, and get guidance from your listing broker and lender broker, because they will tell you, they will look at your T12, your trailing 12 months of financials, and point out things where you have opportunities for either expense reduction or revenue potential based on what they are seeing in the market, especially in that local submarket. Those would be your best strategies to plan your disposition.
Very cool. Another question, hey, around stock market has been pretty bumpy over the last few months. A lot of people are scared to put some more money in there. And the apartment market has not been very friendly either. What would your word of advice be for our audience here who are looking to invest some money in either into real estate or any other asset classes? What is it that they should be looking at over the next 6-7 months? Should they still be sitting on the sidelines, or should they go in with the Pro One operator, or should they put in that money into stocks or oil and gas? What is your word of advice for them?
Always the first starting point is minimum 6 months of living expenses, if not longer. Imagine your primary source of income, whether it's your W-2 or your spouse's W-2 goes away. How long can you sustain? And how quickly can you find that income again? Meaning find another job or whatever else is that source of income. Always figure that out. That's always going to be your number one, your safe money and your rainy day money. Once you have those two figured out, then you look at how much money you have remaining that you want to pool and invest. Always diversify, so never put all your eggs into one basket. But are we talking about your retirement bucket? Because you used to work for a different company. Now you got, 7 figures of a 401k sitting and waiting to deploy. Or is it more of, hey, I'm making good money right now. I'm like in sales, I'm in tech, I'm getting all these bonuses, stock options, but I don't want to have so much money in my company stock. I need to take it and put it elsewhere. So it's regular cash money that you have available to invest. So if so, what are your goals? Number one, do you need a tax break, right? And is that very important to you? Because, hey, I just cashed on a bunch of options that are expiring or whatever, and I have all this money piled. So then if you're looking for a tax break and you don't mind the fluctuation of crude oil prices and you're okay waiting for that money to come back to you in 3-5 years without getting nervous, it again depends on your risk tolerance. I would put a tiny portion in that just as an experiment, just to try one thing. How about technology funds? That's where the 401k money is what I put into technology funds, because it's money that I'm not counting on for at least 5 years. So I can wait without getting any cash flow from it and hope it pays big, right? Maybe it'll go 5-10x and I'll get some good money from it. Again, I'll put a tiny amount in there. What about stocks? What is your knowledge of stocks? Like, I've traded stocks now for over 25 years, so I'm pretty comfortable with it. It's what I've always known. And again, within stocks, I know my tech stocks and retail stocks a little better than, say, medical stocks, because I don't know anything about the medical industry as much. But some of you might be an expert in that field. So pick what you know first, pick what you know well, and do it all for the long term. If you need short-term cash flow, do a first lien position on a house or something that you can go and claim if somebody doesn't make the payments to you, something where you have control. If you need cash flow, if you need depreciation, go with something like oil and gas. In terms of multifamily, it depends on how well you know the operator and how much of an expert they are. How many full cycles have they had? How many times have they bought, sold, and made money? And how are their current deals doing in the last 3 or 4 years that were acquired? Did they acquire anything at the peak of the market cycle, 21 and 22? How are those deals doing? What is the debt service coverage ratio? Meaning, if you are getting so much, let's say you're getting $10,000 a month in paycheck, but your mortgage payment is $11,000, Well, you don't have enough money to pay that mortgage, right? So it's less than one. So debt service coverage ratio of all their existing deals will give you a feel for how good they are in operations before you trust them with your hard-earned money for an investment. So there are such a wide variety of vehicles to choose from. I'm seeing a lot more going into buying businesses or buying things like retail strip centers, medical offices, let's say a strip mall, etc., or actually buying an existing business where a baby boomer is retiring, like a laundromat, a car wash, etc., where it is cash flowing and you're able to assess that business. So, really, the first thing I would do is get some level of financial acumen to be able to look at the income statement and the business plan and assess the potential of it before getting into something. But start small with what you're most familiar with. What's an industry you know really well? Close your eyes and think of Walmart the next 5 years, or Amazon, or Target, right? What do you think those companies are going to do? What companies are in the, QQQ or SPV, to give you examples of stock funds, right? Which ones do you have the most belief in and knowledge in to look at their potential and look at it long term? Now, if you're an active trader, there's a lot of money to be made in options trading. So if you think the market, some stocks or volatile stocks are going to go down in value, there's a put option, right? And there's call options if you think it's going to go up. So start with what you know, keep expanding that knowledge to where you feel confident in making a good decision. Match that with your risk tolerance and the savings that you need to have for your rainy day. And then only invest with money that you're not afraid to lose, because every investment carries risk. And yes, you could lose 100% of your money.
Hey, that's a lot of great advice. Another question, hey, to keep us a little bit more interesting, right? Hey, what is your favorite food?
I love my Mexican food. I can live probably without Indian food for a while, but boy, do I miss my fajitas and enchiladas.
Very cool. No, thank you so much. Hey, I love Tex-Mex as well. Hey, living in Dallas, you can't go
Yep.
wrong with Tex-Mex, right? Before we sign off, any parting comments or thoughts for our audience here?
Try not to get overwhelmed with too much information. Pick one or two things. Let's say I want to know everything there is to know about multifamily investing, as an example. Write out your biggest questions and worries. Make a list. Find a way to get all those questions answered. Like literally track it on a spreadsheet and track how quickly you can do it. Just like applying for a job. In 30 days, I'm going to get answers to these 20 questions from these three different sources. And then that 30-day deadline comes up, it's middle of June, it's end of June. I've made a decision. This is a go or a no-go based on what I've learned. Okay, let's move on. That was a no-go. Let's move on to the next investment. What the heck is oil and gas? Or what the heck is a technology fund? What does it mean to invest in a car wash, right? So write out again your 10 biggest questions or 20 questions, your biggest worries. Find sources to get those answers and set a deadline. Because if you don't, you will just drift. 6 months from today, a year from today, you'll be in the same place where you started. At least go back and say, I reviewed these three types of investments. They weren't what I want. I think I'm going to have to go explore this fourth kind of investment. You're making progress.
There you have it, folks. You have a checklist there. You have a checklist on how to go do some investing. You have some homework there from Sandhya.
Yep.
Sandhya, thank you so much. It was a pleasure hosting you. I have enjoyed the conversation like always. Thanks a lot.
Thank you. You're amazing. I was so impressed with the way you asked me questions, even 2 years ago at Best Ever Conference. You've got a talent for this, so I'm very grateful that you are doing a podcast and educating more investors. Great job.
Thanks a lot. Thank you. Bye bye.